Welcome students. This is the fourth session on ratio analysis. In the previous classes we discussed about two ratios, that is liquidity ratio, another one as solvency ratio. In today's session let us discuss about your activity ratio. First, what do you mean by this activity ratio? Hence this activity ratios means it's a type of financial ratio because it's under your ratio analysis, so it's a type of financial ratios which are used by the company in order to determine the efficiency. In order to determine their efficiency, this ratio has been used, and which can be able to use its different operating assets, the different operating assets that are present in its balance sheet, and convert the same into sales or cash. Either it has the power, or either we guys can analyze with the help of this either how to convert or how the conversion of this your operating assets will be on your sales as well as cash. And under this there are different activities or different ratios where we guys going to see. One is your inventory turnover ratio, or that can be called as stock turnover ratio. That is short, we guys going to call that as STR, that is stock turnover ratio. And second one, debtors turnover ratio. Debtors turnover ratio, this is called as DTR. This is very much important, either for 6 marks or there can be 14 marks. And based on this they will ask your questions, and is very much important as per the previous question papers. This is very much important for your 6 marks question. And next one, as about your, already we are done with your debtors, so simultaneously take down as your creditors turnover ratio, so that is CTR. And next we guys going to look into that. Next one is fixed assets turnover ratio. Fixed assets turnover ratio. And finally that is what your capital turnover ratio. Capital turnover ratio. So first let me explain all this, what does it means, and later we'll go with the formulas. And already I have given the PPTs, I have shared the materials to you as like PPTs and the notes of your ratio analysis. Kindly go through once. Now let us see what is this, all these ratios into different notes. So as I said, first it will be a stock turnover ratio, next it will be a debtors turnover ratio, creditors turnover ratio, fixed assets, capital turnover ratio. Now let us see the meaning of stock turnover ratio. So already the materials has been shared, but still let us discuss your topics. Now stock turnover ratio, which indicates, or why we need to calculate this, means very simple, to determine the number of times the inventory is purchased and sold during the physical year. So we guys going to check how many times we have purchased and we have sold in the physical year. For that reason we are calculating your stock turnover ratio. So now this is the formula to calculate your stock turnover ratio, that is stock turnover ratio is equals to cost of goods sold divided by average inventory. So now how to calculate your cost of goods sold? As we know, so cost of goods sold, that's simple, opening stock, where we can consider along with your purchases, plus if there is any direct expenses, and minus with your closing stock. This is the simple formula to calculate your cost of goods sold. Opening stock plus purchase plus direct expenses minus closing stock. That value will gives you the cost of goods sold. Next, average inventory. So how to calculate this average inventory? Very simple, opening stock plus closing stock divided by 2. So we guys going to consider these two, opening stock along with your closing stock, add together and minus with divided by 2. Now debtors turnover ratio. So what is debtor turnover ratio? Either this can be called as receivables turnover ratio also. Debtors turnover ratio also called as receivables turnover ratio. And why we need to calculate, or what does it indicates? Simple, it shows how quickly the credit sales are converted into cash. The credit sales, how quickly it is converted into cash. So for that reason we guys going to calculate this debtors turnover ratio. So the debtors turnover ratios, the formula is net credit sales divided by average accounts receivables. Now, net credit sales, how to calculate this net credit sales? As we know, as total sales minus cash sales minus sales return. If there is any sales return, we guys going to minus that. So that's the value will gives your net credit sales. And average, now average accounts receivables. In order to calculate these, there are two things: opening debtors and opening bills receivable. We guys going to add this together, and along with that, we guys going to add closing debtors plus closing bills receivable. Add this all the things divided by 2, which gives the value of your average accounts receivables. The third one, creditors turnover ratio. The creditors turnover ratio, let us discuss about the meaning first. So it is known, why we need to calculate, it's very simple. It is known as your payable turnover ratio. So where debtors turnover ratio is known as receivables turnover ratio, and creditors turnover ratio is known as payable turnover ratio. And it indicates the speed with which the payments are made to the trade creditors. Where the payments are made to the trade creditors, that indicates about your creditors turnover ratio. But the debtors turnover ratio, which indicates about your how quickly the sales or your sales converted into cash. Now let us see the formula. Creditors turnover ratio equals to net credit purchase divided by average accounts payable. So here you guys can see, you can compare the debtors turnover ratio where it has asked as net credit sales was on debtors, but on creditors it is net credit purchase. And average accounts payable for your creditors, for debtors it was average accounts receivables. Make sure that. Now how to calculate this net credit purchase, where total purchase minus cash purchase minus purchase return. If there is any purchase return, we guys going to consider that. Next, average accounts payable. So quite similar like your debtors turnover ratio, but here we guys going to consider that bills payable as well as creditors. Opening creditors plus bills payable plus closing creditors plus bills payable divided by 2. This is the way to get your average accounts payable value. Next, fourth one, fixed assets turnover ratio, where it indicates the efficiency which the firm is utilizing its in fixed assets such as plant, machinery, land and building, and etc. How efficiently we guys are utilizing it. So for that, the formula states that sales or cost of sales divided by net fixed assets minus accumulated depreciation. If there is any accumulated depreciation, we guys going to minus that along with your net fixed asset. So as we know, under asset side there are two things. One is your fixed assets, another one is current assets. So here we guys going to ignore your current assets. We will consider only your fixed assets. So net fixed assets minus accumulated depreciation, hence the value will be called as your fixed assets turnover ratio. And next, the last one, capital turnover ratio. The formula states, or let us discuss the meaning first, where it shows the relationship between cost of sales and total capital employed. So where it shows the relationship between the cost of sales and total capital employed. So what is capital employed? It is the value of asset employed in the business, or in another way where we are going to see, it is expressed as the total amount of capital that has been utilized for acquisition of profits. So how efficiently we have utilized our capital into acquisition of our profits. So that's your capital employed. So here the formula is cost of sales divided by total capital employed. Now let us discuss the problem on your activity ratio. The first problem, as we know, is the 10th problem in under your ratio analysis. From the following, calculate activity turnover ratio. Specifically, they have not mentioned about your creditors turnover ratio, debtors turnover ratio, or fixed capital or stock turnover. Just they have mentioned about your activity turnover ratio. We need to analyze the problem and we should compute the different type of ratios. Now, the value what they have given: opening stock where it relates to the stock. So hence where we guys going to calculate your stock turnover ratio first. Now opening stock, what they have mentioned as rupees 40,000, sales rupees 3,50,000. They have mentioned about your gross profit, that is 66,000, and return inwards. So return inwards means so simple, that is known as your sales return. So sales return, that is rupees 20,000, and closing stock rupees 26,000. Now let us see the problem. Yeah, this was the solution. This is problem under activity turnover ratio. Here we need to calculate only one, that is stock turnover ratio. Under the stock turnover ratio, as we know, stock turnover ratio is equals to cost of goods sold divided by average stock. Hence they have mentioned about your opening stock, they have given sales, gross profit, sales return, and closing stock. So we need to calculate your stock turnover ratio. And in order, we don't know the cost of goods sold, but they have mentioned about your sales return, as well as gross profit. As we know, as we previously discussed, cost of goods sold, which equals to opening stock plus purchase plus direct expenses minus closing stock. Many of may get confused. Even this can be a one formula, or we can use this formula also. Why? Because when they are mentioned about your gross profit, we can use this sales minus gross profit, which gives the value of your cost of goods sold. Now sales minus gross profit minus sales return. Now what's the value of sales? That is 3,50,000 minus value of your gross profit was 66,000 and minus sales return, that is 20,000. So now all together minus, and we can identify your cost of goods sold. The cost of goods sold will be 2,64,000. Right now we know the value of cost of goods sold. So STR equals to cost of goods sold, that is 2,64,000. But we don't know the value of average stock. So how to calculate this average stock? Average stock, which equals to opening stock plus closing stock divided by 2. The opening stock, what they have mentioned, that is as your 40,000 plus the closing stock is 26,000 all divided by 2. Now value, that is 66,000 divided by 2. Hence the average stock will be as 33,000. Now bring down that 33,000 under your average stock. Now we can identify the stock turnover ratio. So this is 2,64,000 divided by 33,000, that gives us 8 times. So as we know, the stock turnover ratio, which indicates or which shows that the times of the number of times the inventory is purchased and sold during the physical year. So 8 times we have purchased and sold your sold the under your physical year. So this is what the one simple problem of your stock turnover ratio. Let us discuss the second problem. Problem number 11. This is the problem. Opening stock rupees 12,000, purchases rupees 1 lakh, direct expenses rupees 8,000, and closing stock rupees 12,000. So in this problem, they have not mentioned about your sales return, and they have not mentioned about your gross profit. So hence the cost of goods sold, we need to identify your cost of goods sold, and here we need to calculate your stock turnover ratio. For that we need to calculate your cost of goods sold. So cost of goods sold, the another formula, as we know, opening stock plus purchase plus direct expenses minus your closing stock. All the things what they mentioned over here, we guys going to consider the formula right now. Now let us calculate the stock turnover ratio. First we need to identify your cost of goods sold and later the average stock. In order to calculate your cost of goods sold, as I said, there are two formulas. One is opening stock plus purchase plus direct expenses minus closing stock, or the another formula in the previous problem what we have solved, that is sales minus gross profit minus sales return. If they have mentioned directly this gross profit, sales minus gross profit, that's it. But in this problem they have not mentioned about your gross profit, so hence we are using the another formula. Now opening stock is 12,000, purchases was 1 lakh, direct expenses is 8,000, and minus with your 12,000. So hence we guys going to get your cost of goods sold. As I said, 12,000 is opening stock, purchases is 1 lakh, direct expenses was 8,000 minus closing stock as 12,000. So if you add all these two together, that is 12,000 plus 1 lakh, 1 lakh 12,000 plus 8,000, 1 lakh 20,000 minus with your 12,000, that value will be as 1 lakh 8,000. The next, already we came to know what's about your cost of goods sold, that was 1 lakh 8,000, but we don't know the average stock. Now we need to calculate your average stock. In order to calculate your average stock, the formula is opening stock plus closing stock divided by 2. The value of opening stock is 12,000 plus, and the closing stock is 12,000 divided by 2, which gives the value as 12,000 plus 12,000, that will be as 24,000 divided by 2, that value will be as same as it is your 12,000. So average turnover is, average stock is 12,000. Now divide that value 1,08,000 with your 12,000. Finally, the stock turnover ratio is 9 times. That means 9 times this company has been sold and bought or purchased during the physical year. Now here the another one where we guys going to calculate the calculation of our average holding period. So what is your average holding period? So in this first one where we have calculated the stock turnover ratio, even let us calculate the average holding period. So how many days we guys going to hold that in average? This is a formula, average calculation of average holding period. So average, how many days we guys going to hold that average holding period equals to number of days in a year divided by stock turnover ratio. So how many days in a year means, that's very simple, 365 days in a year divided by stock turnover ratio. See the stock turnover ratio, how much we got? 9 times. So divided by 9. So finally 365 divided by 9, that is 40.5 or 41 days. So in an average, we guys going to hold the inventory or hold the stock in an average 41 days. So this is the complete structure about the stock turnover ratio. So here stock turnover ratio, first we need to calculate your cost of goods sold divided by average stock. Cost of goods sold, the formula is opening stock plus purchases plus direct expenses minus closing stock. So now opening stock was 12,000, purchases is 1 lakh, and later direct expenses is 8,000 minus 12,000 of your closing stock. Finally, the value of cost of goods sold is 1 lakh 8,000. So that's what we have considered over here. Next, average stock. In order to calculate your average stock, the formula is opening stock plus closing stock divided by 2. The value of opening stock is 12,000 and the value of closing stock is 12,000. So opening as well as closing is the same, divided by 2. Hence your average stock is 12,000. So we have considered the same, 1 lakh 8,000 divided by 12,000. So finally the stock turnover ratio is 9 times. So 9 times in a year, during the fiscal year, we are purchasing and selling the stock. Now calculation, how many days in an average, we need to know how many days we are holding that in an average basis in a year. So hence calculation of average holding period, that gives the value of, the formula is number of days in a year divided by stock turnover ratio. You should be very specific. The year might be mentioned over here. So as you know, the 2020, this year is leap year. So hence we guys going to get 366 days. So make sure that which year they have asked and consider the leap year. Okay. Year not at all mentioned any year. So directly we are considering that as 365 days divided by 9. So for 365 days divided by 9, which gives the value as 40.5, or that can be called as, we cannot consider the 40 and of days or something else. So hence we guys going to consider or convert that as your, or round it off as 41 days. So this was the complete structure about your stock turnover ratio. This is the 12th problem. Take down, this is for your assignment or complete in your running notes itself. Need not to write separately in the assignment book, complete in your notes itself. Here cost of goods sold, already they have given computed value, that is rupees 5 lakh. You need not to calculate the cost of goods sold. So hence cost of goods sold is 5 lakh, opening stock 40,000, closing stock 60,000. Here you need to find out stock turnover ratio and average holding period. So same like as your previous problem. Calculate and complete the problem.